We ready? Yeah. How many licks does it take to get to a center of a Tootsie Pop? If you knew the answer, you know how to preserve your saliva or how many licks to give it. Tonight, we are going to go over how the banks view your income to qualify for home ownership. Maybe you need to pay down some debt. Maybe you need to drop the purchase price. Maybe you need to save a bigger down payment. But before you do any of that, if you knew how the banks viewed your income, you know how to prepare yourself for home ownership. What's going on, fam? My name is Min Win with What's a Mortgage. Welcome to our channel. The goal of our channel is to simplify home ownership. If it's your first time tuning in, do me a huge favor. Hit that subscribe or notification button so you are notified every time we go live or post new content. We go live every Monday night on Facebook and YouTube at 8 p.m. and we post daily tips on Instagram and TikTok. So if you're not following us on other platforms, please go ahead and do so. And tonight, we are going to go over how the banks view your income to qualify to buy a home. So if you're going to buy a home sometime in 2023 or in the future, you want to know the income that the banks are going to use, because through that, they will decide how much you can borrow. Through your income and through your liabilities, you can set your budget. Maybe you need to wait to make more money. Maybe you need to buy down the interest rate. Maybe you need to drop the purchase price or pay off some debt. But you set the guidance by knowing your income, because typically people's income doesn't change, but they can change the other numbers. So if you know the income that the banks are going to look at, you'll know how to wiggle through the other areas to prepare yourself to buy a home. All right, Instagram, I will see you on YouTube, youtube.com/What's a Mortgage. All right. What up, guys? You guys having a good night tonight? So let's get into it. How income is used to qualify for a mortgage. Also, if this video brings you any benefits, do me a huge favor. Like this video and share this video with a friend or family that you know that will use this information to buy a home or refinance a home in the future, right? So you want to buy a home, the bank, they're going to want to look at your income, and they want to see that you have the ability to make your mortgage payment. But what income are they going to use? So we're going to show you which income they're going to use and how the banks calculate your income so you can prepare yourself. If you haven't yet, on our Instagram, we have our bio page where you can download our WHAM wallet. It's a financial fitness tool that will help you prepare to buy a home. So now, once you download the app, you can put in the income from what you learned today, and it will help you budget. Okay. On the app, you can also do a soft mortgage credit pool, which is they'll run your credit. It doesn't hurt your score. It will help you see your liabilities with your income so you can budget to either pay down debt, save a bigger down payment, or maybe drop the purchase price, or you might need a co-signer. All right, guys? So let's get into it. So how income is used to qualify to buy a home. There's two things you want to know when it comes to that, okay? It's not what you can afford. Remember that. It is not what you can afford. It's what income the lender will allow you to use to qualify for a mortgage, okay? Just remember that. Say it with me. It's not what you can afford, because a lot of people, they think about the income that they have. It's what you can afford and what the lender will allow you to use. So we have to figure out whose income can you use and how to calculate the usable income, all right? So when you prepare yourself to buy a home, don't just think, oh, I can make that payment, or everyone who's going to be living in the house can make that payment. That's not how it works. And I see a lot of people running to this issue, especially if they're married or they're buying with other people who's going to help them with the payment. Not all the time you can use everyone's income. So we're going to figure out whose income can you use and how you calculate it. I see a lot of people, because they got a pay raise or one year they make tons of money and they realize, why can't I qualify? Because the banks do their own calculations on what they want to use to qualify. Remember, they look at everything as a risk base. They want to see that you have consistency of making that income before they allow you to use that income to qualify to buy, right? So whose income can you use? That's the first question you want to answer. Same thing with debt to income ratio. Whose debt are they using? Okay, so whose income can you use? Only use the income for people who will be on the loan. So if they're not on the loan, you can't use them. I'll answer that in a second. Must be a U.S. citizen, a permanent residence, on a visa or DACA. Okay, only those people can be on a mortgage. They must meet credit qualifications, government loans, 580 credit score or better, conventional loans, 620 credit score or better, and jumbo loans, 680 credit score or better. On government loans, must include your spouse's debt, even if they're not going to be on the loan, unless you're in a non-community state. This is for all community states. On a VA loan, can only use spouse's income if it meets the loan requirements. You can add other veterans if they meet the VA loan requirements. Okay? So those are the people that can go on the mortgage application. So once you before you decide I'm going to use this person's income or that person's income, if they can't qualify based on their citizenship and based on their credit, you cannot include their income. But if you're going with an FHA, VA, or USDA loan, you got to add the spouse's debt, even though the spouse might not qualify to be on the loan. Okay? So a lot of times I see couples buy and they don't qualify because they can't use their spouse's income, but they have to add their debt in all community states. VA also has a special rule if the veteran spouse can afford the debt without the spouse. You can omit the debt as long as, like I said, the spouse can afford the debt alone. So there's ways around that for VA, but definitely talk to a mortgage lender so they can see the full picture. This is just basic guidelines, but if you see the full picture, then the lender can make that decision once they see it. All right. So before you start going this person, that person, this person, make sure who can go on the loan. So once you decide who can go on the loan, now let's look at what type of income you cannot use. Okay, make it easy. Let's do some deductive reasoning. What income can't you use? Because once you identify the person, you want to identify what income you can use and what income you can't. So it's easier to identify the income you can't first. Okay, so here is the income you cannot use. Income from borrower who does not meet the credit requirements. Income with less than 2-year history, unless you graduated school, the transcripts make up that history. Temporary disability income, unless you are planning to go back to work at the same company, aka maternity relief, right? Unemployment income you cannot use. The GI Bill, you can't use that as income. And any undocumented income, considered a non-qualified mortgage for this type of income. If you are W-2 but have not filed taxes, your income is not considered undocumented. Your employer has filed it with the IRS. Okay, so once you have identified what income can't you use, now it's easier to decide, okay, what income can you use? So that's what you want to do. Select, like I said, deductive reasoning. Who can go on the loan? Once you figure that out, whose income can their income be used? If it can't, you got to remove them. Because why would you keep them on there? Because their debt will increase your debt to income ratio. Remember, this is May 2023. Every $430 a month of liabilities and debt, that takes away about $50,000 of buying power. So why add that co-borrower or co-signer when it's going to take away buying power if you can't use their income? Okay, so there we go. If they don't have a history of it, you can't use it. If you want more details, please send us a DM, ask us a question. All right, I'll see a lot of people, they get paid under the table. If you get paid under the table, you can't use that income. If you have income and you're not showing it on your tax returns, you're writing everything off, you can't use that income. You have to use income that has been documented by the IRS and by your employer before you can use that income, okay? It's important that you know that, because I see a lot of people, they don't qualify. The home of their dreams falls on their lap at a discount. Interest rates drop. Home prices come down. Or the government releases some insane grant that helps you with the down payment and closing costs, or a huge tax benefit, right? Or a tax credit. So that's why I do recommend, like I said, you go to the Wham wallet on our bio and on Instagram, download the link, put in your information, start tracking your information so you can get closer to home ownership. All right, so now we know the income you can't use. Let's go over the income you can use. Here are the 4 types of income you can use if you are trying to qualify for a mortgage. Okay. So, number one, fixed income can be taxable or non taxable. Retirement income, 401k, pension, annuity, government ordered or court ordered. Example, Social Security income, child support, alimony, permanent disability, lawsuits. Must prove you are going to get it for another 3 years, especially child support. Award letters or bank statements show proof that you've been receiving it for the past 2 months. It's not what your award letter says, it's what you actually receive. I've seen award letters, especially for alimony or child support, let's say 3,000 to 4,000, but you're only receiving 2,000. So if that happens, you can't use what's on the letter. You can only use what you have proof that you're receiving. Okay. So those are the four. That's type number one, fixed income. So if your parent is retired or you're trying to do a kiddie condo with your child or a family benefit program where you're helping a disabled parent or family member buy a home, you can use their income to qualify as well. As long as it's fixed and they're going to receive it for 3 years, guess what? You can use it. All right. So that's income number one. Now let's look at income number two. You can use to help you qualify to buy a home. It's rental income. Okay. So number two, rental income. If you can use new rental income, vacating property, or new rental property. If you're going to use it on new rental property, you must own a property first. Existing rental income you currently own must be filed on your tax return. So if you're using a property that has rental income, it must be filed on your tax returns. Boarder rent, aka room rent, must be filed on your tax returns. Airbnb must be filed on your tax returns. So when you buy an Airbnb or you buy an investment property and you say it's Airbnb, of course you know Airbnbs rent out more than standard homes. You can't use the Airbnb income unless you have deposits and you have letters from the current owner who already has it as an Airbnb as income. If not, you can only use their fair market rent for long-term rentals as income. You want to make sure you know that because I see a lot of people, they're trying to buy Airbnbs right now, which is super hot. And like, oh, it makes this amount of money, no big deal. It is a big deal if that property is not an Airbnb property already. Okay, remember that when you're thinking about that. When you're trying to upgrade to another property, the current home that you have, you can only use up to 75% of the rental income to help you qualify. So understand these rules when you're using rental income to help you qualify to buy a home. I've seen people, oh, I'm going to buy this rental property. It doesn't rent out positive. Even on government loans, there's a self-sufficient rule when you're buying a triplex or fourplex. You want to make sure you understand these rules so that you have the right income. I've seen people, they love a property. Maybe the down payment wasn't big enough or the fair market rent isn't enough and they can't go buy it and they're already in escrow. Make sure you're working with the right lender if you're buying an investment property or you're going to upgrade and help you look at the fair market rent and make sure you know which rules you can use to help you qualify using rental income. Okay. So number three, self-employed income. Okay. For all you entrepreneurs out there, 1099 people, self-employed income. Okay. So if you're self-employed, you're the sole proprietorship, an LLC, or corporation. Only valid if the company has existed for the last 2 years. Okay. If your company is less than 2 years old, you might have to go with a non-qualified mortgage and put down a bigger down payment. If you're trying to use an FHA or conventional loan, they want to make sure that company has been around for at least 2 years or more if you want to use any self-employed income. And it's really important that you understand that because let's say you had a job that was W-2 and now for some reason they decide to switch you to 1099 or you decide to stay in the same industry but now you're self-employed. You can't use that income until you have a 2-year history. So it's really important that you understand that when you're trying to use self-employed income to help you qualify to buy a home, okay? And number 4, we got that wage earner income, that W-2 income, okay? So with W-2, you have your salary income, hourly income, bonus and overtime, commission, part-time, seasonal, your second job, only valid as long as taxes are taken out before you get paid. Okay. I've seen people say that they are W-2 because the employer cuts them checks. If taxes are not deducted, that is not W-2. You are self-employed. You are 1099. Okay. So make sure that if you want to use wage earner income, that it falls under those parameters and that taxes are taken out of your paycheck. It could be handwritten checks. On handwritten checks, they're going to want to see W-2s. They're going to see a payroll ledger. They're going to want to make sure on your handwritten checks, taxes are taken out, but you can qualify. So those are the 4 incomes. We have fixed income, we have rental income, we have self-employed income, and we have wage earner income. So these are the 4 types of income that can be qualified to use to qualify to buy a home. Okay, so it's important that you figure out who can go on the loan. Second, figure out what income can't you use. You got to remove those people, remove them on the loan as well, especially if they have debt. If they're a spouse, there's not too much you can do in community states, but you want to thin out every reason you can't qualify. You want to increase your chances by having qualified people with qualified income. Right? Now let's go over how do they calculate it. Okay. Now we know what is qualified income. The next, how do they calculate that income? You want to understand that. So when you're using the WAM wallet or using any sort of income calculator, you understand, hey, this is the income the lender is going to use. This is the income I have to help me qualify, right? So let's look at how is income qualified. Here are the different ways they qualify. As is, gross up, gross down, a 12-month average, a 2-year average, year to date, or worst case scenario. So that's how they look at your income, okay? And now let's break it down on fixed income first. So how is fixed income calculated? First, we have your taxable income, calculated as is. Court, government ordered, banks will go off of an award letter or court ordered document. Retirement, banks will go off of the distribution letter or tax return, okay? Non-taxable income will be grossed up. Okay, for fixed income, non-taxable will be grossed up. If it is non-taxable, they can gross it up 15 to 25%, depending on the loan program. On a conventional loan, gross is taxed up 15%. For example, if you're receiving $2,500 a month, it's grossed up to $2,875. Government, USDA, FHA, VA, you can gross it up 25%. So for example, $2,500 will be grossed up to $3,125. So if you are using fixed income to qualify, remember, hey, is it taxable or non-taxable? If it's taxable, you go off it as is. If it's non-taxable, you can gross it up. Make sure you understand that. If you're getting an income and you can't get taxed, but you have proof that you're receiving the income, let's say you don't file it with the IRS, but it was assigned by the court or assigned by the government, you can use that income, okay? And you can gross it up if it's not taxed. If it's taxed, you'll probably see on the tax returns as well. So understand when you're using fixed income, if you have any buyers or any cosigns that have fixed income, yes, you can use them to help you qualify. As long as they have credit and as long as they have income that is verified by either the government, the courthouse, okay? And you can use it, all right? So let's look at next income, self-employed income. So if you're using, is it rental income? Take it back, sorry, rental income, right? So if you're gonna upgrade to another property or you're gonna buy a rental property, this is how the banks view your income, okay? New rent or vacant rent, you can gross it down to 75%. For example, if you receive $4,000 a month in rental income, you gross it down to $3,000. Is this existing rental income? So let's say you already have rental income. They take the average, okay? If it's not what you collect, it's what you show on your net tax returns. So remember that. Either a 1-year or 2-year average, they look at your Schedule E, and they take 75% of the fair market rent as income, okay? So they either go off of your tax returns, or a lot of lenders, if you're showing too much of a negative, they can go off of your fair market rent, okay? So if you don't have a rental property, let's say you have a home, you're going to turn it into a rental and buy a new home, owner occupied, you can use up to 75% of the fair market rent to help you qualify. But since you don't have a history of owning a rental income, you can use up to 75%. For example, let's say you could collect $4,000. That means you can use $3,000. But the mortgage payment is only, let's say the mortgage payment is only $2,500. You can use only up to the $2,500. Let's say the mortgage payment is $3,500. You can only use up to $3,000. Okay, you can use up to 75% to help offset your current mortgage payment. If you're buying a new rental income, let's say you own a home, you're buying another home as a rental property. Okay, you can use up to 75%. Same way. Okay, let's say it's $4,000. You can use up to $3,000. If the mortgage pays $2,500, you can use only up to $2,500. If it's $3,500, you can only use up to $3,000. But if you have a history of having other rental properties, you can use the full 75%. All right? This is for predictable future rental. If you currently have a rental property and it's on your tax returns, they will take the average of the last 2 years of your net return. You add back depreciation as well, and then they average it out as a 24 months. So you want to look at the net income. So whatever, not what you take in minus all your deductions, you add back the depreciation, they divide it by 24. If you're super negative, depending on the lenders, they have a way to somewhat get around it where they let you use the fair market rent, which is 75%. It's on a case by case. Make sure you're working with a lender and tell them, hey, that understands that. So when you do have rentals, you want to make sure, hey, this is my tax returns. That's why it's important that you have all your income documents up front so a lender can decide, hey, it's going to be easy to qualify or not. You might have to go with a non-qualified mortgage, right? So that's how the lender uses rental income. They calculate down, okay? They don't calculate up because they minus other costs of owning property, right? So your third type of income now, let's look at self-employed income. If you're buying a home with self-employed income, this is what I want you guys to know, okay? How is self-employed income calculated? Just like existing rental income, lender will go off of the net profit on your tax returns, not what your gross receivables, your net profit on your tax returns. They take a 2-year average of your income. The company has to exist for at least 2 years. Applies to all loans, conventional, FHA, VA, USDA, and jumbo. There is a 1-year average loophole only for conventional loans. If you're putting 5 to 10% down or more, 700 credit score or better, you have to own the company for at least 5 years, or you've been self-employed for 5 years or longer. So if you're self-employed, just understand that they don't go off of what you receive on gross, it's what you receive in net. That's why I see a lot of self-employed people have a hard time qualifying. If you do have a hard time, that means 1 year, if you're going to go conventional, you're going to have to show income and not write off everything, and you might owe the IRS payments. Just add those payments to your debt to income ratio to qualify. If you don't want to do that, which a lot of self-employed people don't want to do, it's fine. Just put either 10 to 25% down and buy with a non-qualified mortgage. You are going to get a higher interest rate, but remember, you wrote off everything and you didn't pay any taxes or minimal taxes to the IRS, which is your right. But because that is your net income, that's what the bank is viewing as your net income as well. So they're going to use that income to say this person has this income to make their mortgage payment, because everything else is a deduction and a write-off. How can they make that payment? So if you are self-employed, you've got to be well prepared. So if you're self-employed, I would prepare myself a year, 2 years before buying a home. What I would do first, show your income tax to your lender before you file, and they can tell you, hey, you wrote off too much, okay? And they can talk to you, hey, if you wrote off this much, you might not qualify. So you might need to go with a non-qualified mortgage, or maybe the following year, you don't have a lot of deductions, right? You don't write off as much, so you show more income. But talk to a lender so they can help you prepare yourself, then go talk to a CPA or a tax person, because they might say, it's not worth it. Deduct everything because you're saving so much more, and use that money and put a bigger down payment to buy a home. And with a higher interest rate, maybe you can use a home as a tax deduction as well for your business and deduct more. But see a lender, then go see a tax person, all right? So that's how self-employed income is used to qualify to buy. Now let's look at our favorite and the most common one, wage earner, W-2 buyers, okay? How is W2 wagers income calculated? They go off of first hourly and salary income, calculate. If there is a pay increase, you must wait 30 days before using the new income. If you started a new job, company, or position, you must wait 30 days to use that new income. Okay. Overtime, bonus, part-time, seasonal commission calculate as an average. 12 month to 24 months or year to date. This is why I recommend, if you have some type of irregular income, have a lender look at it to help you decide what income the underwriter is going to use. Then you want to input it into your WAM wallet and then use that to track your debts, your purchase price. If your income increases, just change the number in your WAM wallet, right? See, W2 income is the easiest income to qualify. They're going to go 40 hours a week times 52 weeks divided by 12, right? If it's hourly, it's easy. Like I said, 40 hours times 52 divided by 12. If it's salary times 12, or salary each month. They'll figure out the number monthly, and that's the income you're used for your base income. Any overtime, bonus, commission, they average over 12 to 24 months. Of course, if you haven't been there for 2 years, as long as you have history at your old job that makes up a 2-year history, then you can use overtime, bonus, or commission. Make sure you have a 2-year history. A lot of times it gets funky where, let's say you were working at a car dealership and you got a salary income, and now you're commissioned and you're at the same dealership, but you make way more now. They might not let you use all that income. They might only let you use what you made hourly, and as long as you make more than that, they can use that as your income, your old hourly. So if you have irregular income, talk to a lender, find out what the underwriter is going to use so you can input it into your calculator and figure out, okay, this is what I have to work with. Or they can put that in you can put that in your income calculator and say, hey, when can I use my bonus? When can I use my overtime? When can I use my commission? You want to know these factors so that you set yourself up for success. Like I said, 6 out of every 10 buyers that qualify don't qualify for what they want, or they don't qualify at all. And it's because of the budget. And then one of the main factors of the budget outside of credit is your income. A lot of other things you can change. Typically, income stays the same. So you want to know the standard income the lender is going to use to help you qualify. If you have some funky income outside of what we talked about, you can always give us a call or send us a DM, okay? Let's go over some common W2 dilemmas, okay? This is where we're probably run into the most dilemmas. So on salary and hourly, if commission is more than 25% of your income, you must wait 2 years to use that income to qualify. If less than 25%, you can use that income. Okay, so if you want to use commission or salary, that's over 25. If your commission is over 25%, you got to wait 2 years. Now let's talk about overtime and bonus that is less than 2 years old. You cannot use it. You must wait 2 years to use overtime or bonus. I see that happen a lot. If you have a 6-month gap in between jobs, you got to wait at least 1 year. If it's seasonal, you must have a 2-year history to use the new income. Second job, you got to wait 2 years to use the income, and you can't have a gap in either jobs. Salary, hourly, per diem, stipend, you got to wait 2 years to use a new income. I see these irregular dilemmas a lot. So if you have a dilemma that is not on here, please give us a call or send us a DM, right? Or you can use the WAM wallet, and then you can ask us to help you look at your income and say, hey, this is the income you want to put in the wallet so it can help prepare you for home ownership, right? So hopefully now you know what lenders go through. Realtors, you know what lenders go through, and now you know how to prepare yourself. You can see what the banks are looking at and how to qualify yourself. Number one, you want to make sure who's going to go on the loan. Now make sure they can go on the loan first based on their credit. Then you want to remove everyone who, if the income is not, you can't qualify the income, okay? You can't qualify the income, you want to remove them. And now we know with the different incomes you can go through to qualify, all right? So we went through fixed income, rental income, self-employed income, and W-2 income, all right? So hopefully this information helps you. If it did, do me a huge favor. If you're not following me by now, please hit that follow button. All right. Also, if this video brought you a lot of value, please like this video and share this video with anyone you know that will buy a home in the future. All right. Before we get to some Q&A, if you want to know how to follow us, here are our links. If you want to know how to follow us or contact us, okay? 714-790-9697. You can email us info@whatsamortgage.com. If you have a question or if you have a loan estimate, you want us to help you find a lender that can beat it, send it in, info@whatsamortgage.com. If you want to download this income information or our credit information, you can go ahead and go to whatsamortgage.com and download our Ultimate Mortgage Guide. All right. This guide will help you understand and break down on how to qualify for a home. Like I said, 6 out of 10 people that race to apply, when something good finally happens to them, rates drop, price drops, the dream of their home falls in their lap with a lower price, or the government releases some ridiculous program, which just happened in California, they don't qualify. Prepare yourself, fam. That's all I ask. All right, let's get some Q&A. So here, thank you, Tony. I can't see anything. Hopefully you can see it now. Lupita, Mela K. I'm interested in buying a new build home and they're suggesting to go with their preferred lender and he is out of state. Do you think it's better to go with a local lender? Mela K, I would probably go with, builder lender. I'm just being honest with you. When you buy new construction, the builder has built the closing costs into the price of the home. So if you don't use a builder lender, use your own local lender, a lot of times, probably like 95% of the time, they won't let you use the builder credit. So I would use the builder lender because of the credits you're going to get. You can take the builder's pre-approval, grab the credit report, and show it to a local lender. Most likely, it's hard for the local lender to beat it, but at least you only have your credit ran once. Don't go run it with a local lender because the builder's going to want to run it again. Run it with a builder and use that credit report and shop it. If you do find a better deal that can beat it and the builder's going to give you the credit, then do your own thing. But if you were my relative, right, my family member, I would tell you use the builder lender first and see their options. Hopefully that helps you out. Okay. Second question. On a 2-year history for a person who graduated pre-pandemic. If you graduated pre-pandemic and you haven't worked, say it again.
Scroll down more for the rest of that question.
Okay. All right. Zoom see here. I graduated in 2019, but took on a job and a high base pay salary 2022, which aligns with my degree. Although I also kept my first 7-year job, so overflow. Now I work 2 jobs. If you had 2 jobs for 2 years, then you can use it. If you got that base salary job, if you're keeping your full-time job and you have your base salary job in 2022 and using it from your degree, then yes, you can use the income. That's a 2-year history right there, okay? Hopefully that helps you out. Let's go back up. Michael, so why are condos so high on HOA? I'm trying to buy one as a rental, but don't have enough to hit a 20% to avoid PMI. Condos, the bank look at it as a higher risk because you don't own the land, okay? So I don't know why the HOAs are high. All associations sets their own HOA, but lenders on convention, on FHA, have these loan level pricing adjustments that make condos a higher risk. Attached condos, not detached, all right? Hopefully that helps you out. Full-time or Michael Lopez, also I have a high interest rate HELOC. Where do you advise I refinance? I'm looking for a fixed home loan to cover. Can I do it by refinancing? I wouldn't refinance right now, Michael. If you have a HELOC, you can either convert that to a HELOC and the rate is fixed. If you don't have a first and your HELOC is really high, then you can do a cash out refinance HELOC and convert it. I would need to know the full story. So if it was me, if you have a low first, I probably wouldn't consolidate with a HELOC unless the HELOC is ginormous, okay? If the HELOC is small, I would either make the HELOC payment or convert it to a HE loan or wait for rates to pull back and then convert it to a HE loan and then to get the lower rate, all right? Hopefully that helps you out. Rural government is USDA, Martin. Bank statements, they're going to go off of a 12 to 24-month deposits. If it's business, they only go off of a specific percentage. If it's personal, they can go off 100% It all depends, AO. Okay, please send me a DM for more details. What up, Mayan? How you doing? For wages, if I called off one day but it's covered, paid by vacation, is it counted? Yes. If you take time off and it's covered or you still get paid on it, it still counts. Is there a default percentage of stated revenue they're considered as income? Is there a default percentage of stated revenue they're considered, or does it have to be signed off by CPA? The lender will look at your 24-month bank statements or 12. They either go off of 50 to 75% depending on the lender you're going with. Hopefully that helps you out, okay? Can you use cash as income? No, you cannot. If you have cash as income, Christy, then you need to go with a non-qualified mortgage, okay? Hopefully that helps you out. I plan to get a new job in about a month, but want to buy my home first by the end of the year. I have a 2-year work history. Do I need to be at the new job for a certain period of time? Carrie, if you change jobs right now and it's in the same line of work, same industry, or same position, you get paid more, and you just need the base income, you can change and you can buy within 30 days. Hopefully that helps you out, okay? All right, Marianne, thank you. Guys, I really appreciate everyone who stayed this long and watched. Again, if you're not following by now, do me a huge favor. Please hit that subscribe button, all right? What's the risk behind probate homes? Depending, sometimes if you're buying a probate home, if it's the heirs have first chance to go in and buy it from you. Also on probate, you might get excited about it, but someone you can outbid you. Okay, that's the difference with probate. So don't get too excited on probate yet. But if you are the next of kin, you have the higher chance of getting the home. All right, hopefully that helps you out. All right, guys, like I said, thank you guys once again. If you do need to go get a hold of us, here's our information. Okay, 714-790-9697. Okay, give us a call. Send us a text message if you need anything for any shy guy, shy girl, or shy person. You want more information about all of this, go to whatsamortgage.com and download our Ultimate Mortgage Guide. Okay, let me answer here. Chris, I work in the movie industry, and we work a couple months of them have a time off before starting a new job, W-2. If it's W-2, they take a 24-month average, Chris, all right? Send me a detail. If you work for a union, makes it even a lot easier. Send me a detail, give us a call or send us a text, all right? 714-790-9697. I'm going from working in a software to education. I would need to see the full income carry. Yeah, that would be hard to go from education. If you're using a degree, makes it a little bit easier. With education, it would let's say you went from selling cars to all of a sudden now you're moving boxes. That could be different. Software to education, there's a way to kind of make it look like it's consistent, all right? Send me a DM. Malay, I would probably buy 5% down right now. 5% down. I probably wouldn't do 20 unless you could put 20% down and you don't even blink. In times like this, 20% down is hard for a lot of people. If you put 20% down and you don't blink, then yes. If you have to blink a couple times, I'd probably back off, all right? Hopefully that information helps you out. All right, guys. Thank you guys once again. I really appreciate everyone who logged on, commented, and asked questions. Guys, we want to end all our episodes with our attitude is gratitude. Without you, there is no us. So thank you guys so much and have a great